All right. Let's play a little fantasy league, but for traders. If you had to build the ultimate scanner, what are you feeding it? The alpha is out there, but are you throwing darts at a wall of tickers? You want edge? Let's break it down and get the ingredients that actually matter and toss the rest of that crap in the trash after the bell. Just us. Right?
So Lex, are you going to get in trouble from the what is that, the FTC or whoever, for saying crap on YouTube?
No. Okay. Occasionally.
Know what you really need to get some edge? Just like 2 or 3 more screens in your back.
Yeah, look at that. I'm in the lab, man. Look at that.
Just crazy. 2 or 3.
I know. So no Mark today. Mark is finishing up his final touches on the wine cellar. So he's very deep into that project. Has been outside the markets for the whole week. But anyway, here we are. So here's where this came from, this topic today. It came from someone close to me in the family, and he's a new options trader and learning about it and moving along, going to build some algos and some workflows using the Tradier APIs as well. So all good. And his question was the following, okay? And let me just throw it. I'm not going to throw it up. I'll read it. If you're building a scanner to surface setups and detect some sort of edge, what inputs matter? And he gave a list, but we can talk about them. Greeks, IV rank, open interest clusters, dealer positioning, Jason, or anything else. So let's talk about that. Again, it's all around options, not necessarily direction of a stock price per se, because there was not a question of technical setup. So we'll probably leave that one out unless you have something to say about it. But let's get into that a little bit and find out what's valuable. You want to go first?
Yeah, sure. Well, first we could go through the list. You said Greeks.
Yep.
Well, first of all, before we actually go into the list, can we define what edge is? I mean, that word edge or alpha is tossed around quite a bit.
Yep.
To me, I mean, it's the equivalent of if, with enough trades, you will make money, right? Like overall, you'll make money, kind of like a casino with blackjack. Over enough hands, they will make money, right?
Correct.
So like from the probability standpoint, right? Can we agree on that? So like, sure. Okay.
And let me just add something real quick there, because I have, from my background, I have a very different perspective of edge, right? Being a market maker, right, in my past life. So my edge is way different in my mind than what a retail trader's edge is, because quite frankly, you as a retail trader, for those of you who are listening, you give up edge to get into the position. Okay, you are very much rarely getting an edge on the particular trade when you get in. So your edge has to be a different time frame. It's not instantaneous of when you get it, because you're giving it up. But anyway, go ahead.
Yeah,
sorry.
Yeah, like the market maker edge is between the bid and the ask. But what you're getting for that, what you're paying for is adverse selection. So because you are the one that's deciding what the trade is, not the person on the other side.
Right.
So that's what you're giving up. But so it's, that is instant edge for the market maker, but over enough trades, the market maker makes money. So that's true edge, right?
Yep. And by the way, to understand the difference too, and you mentioned the casino part of it, and we're not trying to make this like it's gambling. I don't want you to get that impression, but it's a good analogy, because the house in Vegas has that specific edge. It's mathematical, and they want to have as many occurrences on a positive edge situation as they possibly can. Same with the market maker. They have a very similar stance in the market that a casino has. They have an edge proposition. Does that mean all gamblers lose? Probably. Does that all? But not always.
Only on the aggregate.
Yeah, in the aggregate, right. But you can have a really good edge system where you play well and actually come out ahead. Or it could be a game like chess or poker where you're playing against something else and you're not playing against a house system, right? It could be something like that. And that's where the time aspect comes into it a little bit, right?
Yeah.
So, yeah, go ahead with that.
Lex, let me know where you gamble on chess. I would love to go there. But anyway.
Because you want the other side?
No, I'll take the other side of the table. I'll gamble on chess. But that being said, the mathematical edge is there at the casino, but that does not mean, number one, that the casino doesn't have losing days, because they do, right?
Yep.
And number two, it also doesn't mean that no gamblers ever come out on top. Like there are some, maybe you're counting cards, maybe, there's some other kind of edge that is not mathematical, that the casino, that can give the gambler that edge, right? Yep. So just because the casino has the mathematical edge does not mean that there's not an edge on the other side of the table, right?
Yep.
So there, now that we kind of defined what edge is, let's go through the list. You said Greeks.
I said, yeah. So, and this is a sample, right? So, and there could be others. So let's try to nail them all. Greeks, IV rank, open interest clusters. Obviously where open interest lies on the options chain.
Yeah.
Dealer positioning, which is near and dear to your heart. So that's going to be Gamma, Vana, Charm, among other things. Any of these or any combination of them give the retail trader some opportunity, some edge.
Let's go through some of these. When you say Greeks, what the Greeks are derivatives basically of an option pricing model. So the only way I think that Greeks would give any sort of edge, because that's a mathematical thing, the only way I think they can give any edge is if somehow you have a better option pricing model than anybody else. And I would say that is extraordinarily highly unlikely, right?
Yeah, right. So let me throw something out there and you give me your answer, because I just thought about this when you said that. What if a retail person was savvy enough to create his or her workflow using APIs and build some automation, okay? And was able to see trade data, last trade data. So some gigantic trade came up, okay? And kind of what you do at Volland, you saw that it traded very near the offer, and it was a call, okay? And it was size. I mean, it blew through the threshold. I say you put 10,000 in there. I'm making that up. The assumption there is that the market making community sold that option, right? Most likely, not 100% true, but most likely. Well, if they're selling calls, what do they have to do? They've got to probably buy some stock or buy some other calls, but could have a tendency to drive that stock a little higher in that instant. So if this workflow were available that saw that on that scanner and instantaneously put in a purchase of stock or a purchase of something that got him or her long and flipped it out, is that feasible? Or is it just too much technology and fastness to take advantage of it?
So I think, now we're kind of getting into what Volland does, which is, take in every single trade and make a very good kind of picture of what the dealer book looks like in terms of Greeks. There you because the dealers act in a, I don't want to say predictable is not the right word, in a regimented kind of way. What?
Yeah, it's patterned, so it could be something predictable. Okay.
Yeah, so like patterned way, I think you can get a certain level of edge. It's probably pretty quick. Like if there's like a very outsized trade put on, like somebody bought a call and it's 20, 30 times any other trade on that underlying, you'll see some movement in the underlying stock, I think, but you would need to have an idea of how is that hedged over time in order to get an idea of where, to get a real edge, especially on a swing time frame. I think if you're looking for something like that immediately, Like there's a bunch of services out there that identify unusual option, right? Unusual option volume.
Yep.
And so there's that, but in order to get that edge, the immediate delta edge, I think you have to be quicker than the market maker, and I don't think that's very possible.
Well, then that's why I said it's got to be automated. So you have to detect it, and whatever your trigger is, hey, if X amount of trades over a certain value, buy me the at the money call. Again, I'm making that up, or buy me the stock. I mean, that's going to happen instantaneously if you're a programmer and can do that.
Right, but the edge that we use in like Volland and like how I trade and in Curios and stuff like that is when that comes in, and I'm not quick enough to get that initial delta hedge, but as time or implied volatility changes, we can see how that will change the deltas on that really big option, and we could see dealers will help flows either in the positive or negative direction. And, because dealers, they don't hedge their Vega, they don't hedge their premium Greeks, that is like Vega Theta kind of stuff, as regimentally as they do Delta and Gamma, right? So if we see kind of how the Delta is going to change based on, some of these other Greeks, then you have something, because you're looking at, kind of like if you knew, if you're playing poker and you knew somebody across from you always calls whatever bet is put out there, you kind of already know, oh, they're regimented. They're going to call every single time. So I know that if I have something, I should put in quite a bit of money because they're going to call. And, but if I don't have stuff, I should not try to outbid them. Right. I should try to maybe keep my bets a little lower or something like that. Your behavior changes based on what the other person is doing. So when you kind of have an idea of what the other person's got to do, then you can, all right, that's an edge. Now, is it guaranteed? No, because there's other people than that guy out there. But, that there is an edge, though. What somebody's going to do, and they're a pretty big part of the market.
Yeah. So the delta part of this is interesting of this first Greek discussion, because what we had on the floor back in the day is we had the ability to see who was on the other side of our trades. So if Goldman Sachs came into the pit and said, I want to buy 10,000 XYZ calls, guess what? That stock's going higher. I'm telling you right now. They have, there's something going. It could be from their trading desk, or it could be a customer. You don't know, right? It could be their institutional trading desk where they're like, guess what? Something's coming out. We're buying calls. So that's interesting inside information, knowing, who's on the other side of the trade. Now, I don't think a retail person has that ability. I don't believe.
No,
I don't think that's available information. So that would be super valuable if you could get that.
Yeah, the only thing they have in the Oprah feeds are they have like a ID tag that's like this huge number, and we've even looked at patterning them, but it's not it doesn't help. Yeah.
It takes a okay, so but getting aside from some sort of automation, getting a Volland feel of a delta position, or even a gamma position, it's not more of a day trading kind of thing, I don't think, is what you're saying. You're not going to jump on it before anyone else necessarily, unless you have built that automation. Then you have a chance.
Yeah, I mean, you're going to have to be on site too. You're going to have to be in that server farm, because that's where they are. You're not going to beat the delta hedging, and even if you do beat the delta hedging, then they're not going to delta hedge, because all of a sudden the price went up to their area, right? So they're going to be like, oh, look, they did our job for us. Thank you. So I don't, you're not going to win there, but you're going to know from Volland, what we try to do is try to get an idea of what the total dealer position is, so that when the market does something, we know how they have to react. So then you can kind of make moves like that.
Yeah. Okay.
So that's our edge, and we can, but so, and I don't know if you count that as Greeks, but Another
Yeah, I'd
thing.
say that's Greeks. Let's put that in the Greek bucket. So that's
Okay.
and Greeks can be
I thought it'd be more
about
dealer
the second order
positioning,
one.
but
Yeah, the second order one. So that we'll call that all the same.
Yeah.
And we'll add dealer position and link that with the Greeks. The next one is IV rank. Okay, and here's what I think this means. And we did this a good bit. So we were able to scan on trades that occurred, option trades that occurred, based on a percent above or below an average implied volatility. So 20% below, 20% above. It doesn't have to be the same number, whatever. And when the options trades occurred, if it doesn't meet that trigger zone, nothing happens. But when it does, it pops up and says, "Oh, this option just trade. Your implied volatility average was 20. It traded at 30, and high vol alert kind of thing." What can a retail person do with that information, if anything?
So I mean, implied volatility usually, there's kind of a I don't want to say like a debate, but there's kind of this thought that implied volatility wags the underlying dog, right? Like when implied volatility changes, then the underlying changes. Like dealers push it in one direction or the other. I don't think you can take implied volatility in a vacuum. You kind of have to see, number one, what is the realized volatility? So the start of pricing starts at realized volatility and returns distributions, right? And that's how the start of a pricing model is. And then, so you kind of have to look at that. Is there going to be any events? Like you're going to say, wow, implied volatility exploded. But then you realize, oh, they just announced an event between now and then, right? Like there's like some, Apple iPhone release or something like that, right? I'm just, spitballing, but, and if there is, then you kind of have to say, oh, there's an event happening. There's a reason why the implied volatility went up. Now I can, one thing you can do, which, I've done sometimes, but there's just not enough edge in it, is you look at earnings, like when you think the next earnings date is, and you try to buy that implied volatility. And it's interesting because then you can, that implied volatility will go up, with the options after the earnings, and the implied volatility before it, like right before it, would go down. And you try to pick, before they announce the earnings date, you try to pick that date as quarter ends. That's kind of fun, but really implied volatility it's not something that can be held in a vacuum. I put it on my scanners. Like I definitely look at it. But like I said, I can't, it has to be taken in a certain context.
Yeah. So one of the things that I like, you said it here a little bit, I want to go back to it, is I'm going to say the relationship of implied volatility to realized. Okay. So there is a risk premium there. So implied can either trade above actual or below it. Okay. And there's probably a common pattern to each individual stock or underlying. SPX, Tesla, Apple. There's probably an average distance between implied and actual. Okay. And then there's an extreme, a 2 standard deviation up and down, right? So my feeling is that if you could scan for that, okay, and here's what I'm getting at, okay? Maybe Apple, the implied never, I'm making this up, so don't take this as gospel. I'm just making it up so you understand the point. Maybe implied volatility in Apple never goes beneath actual ever. Okay, so having said that, if that's true, when Apple implied gets near actual, it's a buy, even though it's above actual, because it never gets below it. And then maybe the high point on an IV rank there is that IV in Apple relative to realize is 25 points above. That's the high, and low is at it. Guess what? You're never going to get below it. You buy it when it's at, and you sell it when it's 25 cents or 25 points above it. Does that make any sense?
Yeah, it makes sense. But another thing that I think you said that is important is Apple has its own kind of realized volatility and implied volatility thing. It's not the same as SPX or Tesla or anything else. So not only do you have to know, what that IV and RV is relative to each other, but you also have to know, how does Apple react toward certain positioning or certain, things that happen in the market. And, what kind of decay does Apple have? It's not going to be the same as like a Tesla level of volatility decay toward the end.
Yep.
So you kind of have, I guess, when you're trading like that, you kind of have to have a time in front of the screen in order to see how Apple really acts, and then you could take advantage of disconnections.
Yeah, and it's easy enough to figure out too. Especially if you're handy with a spreadsheet or your Cody. Even some of the systems, like I know our Tradier Pro looks back at implied versus actual on the graphing page. So I would take a look at that, because that's something that you can even do just intuitively looking at a picture. You can kind of look at that a little bit, but really study that well, because a lot of times we noticed that on the market making side when we had big Vega positions and we knew when to get those. And it wasn't always because implied was underneath actual. We hardly ever saw that. And I'm not just talking about Apple. I'm talking about a lot of things. But there's something to be said. And you say this all the time. When implied volatility is low, actual is probably not low enough.
Right.
And conversely, when implied volatility is high on an IV rank, it's probably not high enough relative to how the actual is moving. So, it seems counterintuitive. I might be buying high volatility and have an edge in those situations.
Yeah. I think you're right. I think the edge, though, is like, we said, and it's stock specific, but the edge is knowing how the market reacts to the times in which, IV and RV are close or far apart or whatever. Right now, I mean, the thing I look at all the time is SPX, very liquid, etc. Until yesterday or recently, IV was very high compared to realized vol, like much higher. Now there is that event coming up next Friday of this tariff deadline. So there's things, and I think FOMC is next week, right? So there are things that are happening, but overall, though, I think that that still was very high compared to realized vol. And yesterday you kind of saw that press down a little bit. People started realizing, I should sell Vega here. So but it was but my knowledge of that was really just time in front of the screen. It wasn't, an experience with the underlying. It wasn't, there's not like a standard for every single stock or something like that.
Yeah. So that's good info. Let's hit a couple more of these. I know we're running a little late here. So open interest clusters. I'm gonna kind of put that with dealer positioning a little bit, only because where that open interest lies. If you use your product vol.land, you're going to be able to figure out, whether they're long or short that open interest. That's more important to me than knowing that there is open interest. I'd like to know which side they're on. So we've talked about that already. So that's dealer position as well. The other one was what? What am I missing? I'm missing one of these. Am I?
I don't know. You got to let me know.
I got to let you know. We talked about.
I think one that a lot of people use that I don't know if your friend mentioned is unusual volume.
So I guess I said that with implied volatility, but let's hit that because that's important. That can be important. Go ahead.
Yeah, I think unusual volume is good depending on how unusual it is. Not long ago, I forget the stock. I mean, by not long ago, I mean like 8 months ago. When you're old like us, not long ago is like a year, right? But to my kids, it's like a week. So, but not long ago, there was a stock that just came out with an IPO, and there was one, huge investor in that IPO, and pretty much like a week or two after the blackout period, there was this huge outlier of calls that were, that we noticed in Volland as sold. And it was, there was nothing, there was, it was a recent IPO. There was option traffic, but not a ton until this one thing. And it showed this huge, unusual thing. And we realized the only people that could have enough stock to sell against that is this big investor. They clearly sold they're clearly trying to collect premium by selling these calls that were out of the money.
Yeah.
So it can give you some insights, depending on how that was very unusual. But sometimes in some of these like chat rooms and stuff that I'm in, or Discord, in our Discord room, somebody comes up to me and says, "Oh wow, somebody just bought 3,000 puts on 0 DTE in SPX, like 15 points away," and I'm like, that's 20 cents, 3,000. That's like nothing. Like, don't sit there staring at the Thinkorswim, time and sales, or the Tradier Pro time and sales, sitting there going, aha, 1,000. That's not going to help you,
Right.
So I think in certain contexts, I think it's good, but
okay.
Yeah.
So I thought of the one I wanted to mention, okay? And you might not agree with this one, and it's okay. This is one I like, and I'll tell you why, okay? So one of the things we did in our pro days, at the latter part of it, is we measured skew, okay? And we figured out in Apple, Tesla, yada, 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 on down the line, what a normal skew should look like, and what a steep skew was, and what a flat skew was. And when it got flat, we would buy downside puts to sell upside calls. When it got steep, we would sell downside puts to buy upside calls, and it was normal. We would trade back and forth. Okay. And the best way for our viewers to understand that, and it's simple. Okay. You don't have to make this crazy mathematical. You simply take the 25 delta put volatility, subtract the 25 delta call volatility. It comes up with a number. If the number is 3.00, that means it's 3 volatility points different. Okay. Implied volatility points. Take a look at it. Go back in time. Measure that at 10, 20, and 30-day increments. Always look at those. Why? Those are the ones that are going to move the most and fastest with news events and things that go on. The far-dated stuff is like an ocean liner trying to park that into a harbor and maneuver a gigantic cruise ship. They don't move as much out there. Look at 10, 20, 30. Get a feel for what that is. Because if it's normally 3 in Apple, and I'm not saying it is, I'm making it up because I don't remember. If it's a 10, something's going on. Market makers are selling the living daylights out of downside puts, and they're getting hung up on position, and they've steepened that curve. Okay, you can jump in at points like that and make an intelligent spread, selling a downside put to maybe buying something at the money. You never know, but you can make an intelligent spread knowing that data. I love that skew data. It's really, really helpful for me to seeing some of those curves. Any comments on that?
Yeah, I do really. I mean, skew is a huge volatility metric. You don't, measuring it, that is complete is a different story too. I mean, some people, I like the 20 delta, kind of thing.
Yeah,
but then also getting skew. Yeah. So here's the other thing too about skew that I always find strange, and maybe you can answer this for me, is skew is price smooth, right? Even on very illiquid options and stuff like that, It is price smooth. But the dealer positioning is not smooth because, a lot of people put in at the, like an SPX again, like the 0-0 or the 2-5 or the 5-0 strikes, right? So you can almost like kind of look at that and say, not in 0 DTE, that gets filled out pretty quickly, right? And pretty well. But you kind of look at the 30-day and you say, there's a lot of traffic up here in the calls. And I use Volin to see what side that is. But there's a lot of traffic up here in the calls, and there's a lot of traffic down here in the puts. Skew seems flat for that amount of traffic. Maybe there's, so again, I think skew has to be taken in context. But if you combine it, you combine it with Volin, it's great. We use it all the time.
Yeah.
But even if you don't have Volin and you combine it with like the OI kind of stuff, it's going to be harder to see because you're looking at a whole chain and you're trying to track that at all times.
Yep.
But you can get an idea. Maybe this is overpriced or underpriced skew.
Right. I love it. Yeah. It's the data's available. You can do it yourself. You can download or send to Excel, some values on that. Keep a database of it. Keep in mind though, you want to watch that 10, 20, 30. Keep that kind of as your your focal point. And then once you get that solidified, you can maybe move out another 30 days to the 61. Beyond that, I'm not finding a ton of value, unless you're a long-termer, but I'm guessing most retail people really aren't. So anyhow,
yeah, that's agreed. I think that because skew is most reactive, I think like within the 1 month time frame, and you always kind of have that time ticking kind of thing too with that, like exponential constant of time keeps creeping forward the days to expiration. Right. So you have like an idea of where that skew will go, and if it's overpriced skew within a month, then and there's no events that of, then you can definitely sell that skew. And a lot of people, I think a lot of people like to do that. So
I agree. That's good. Okay, we got to go. I put some things in the comments for everyone. So vol.land, right? A damn funds I didn't put in there. You want me to put that in there?
Sure.
If I can spell it. Is it EU?
Can I put it in?
Yeah, you can see it.
I got to connect.
So a couple little advertising for everyone. Don't forget to sign up at subscribe to hub.tradier.com. Some of the things we're doing coming up. I am in the midst of taping a mini series educational video. So it's going to be beginner, intermediate, advanced, expert. Jason will participate along the way. And so will Mark. We will have guest hosts who are experts in certain parts of that kind of contribute. It's going to be curated. It will always be available on the hub, but you must be a subscriber. Subscription is free. So go to hub.tradier.com and subscribe. Otherwise, you won't be able to see that. But it's really good stuff coming up. And we're doing it with SIBO, and we're doing it with MIAX and CME and OIC. So it's going to be a really great series and very educational. What else? Vol.land we have in there.
I'm trying to get it in there. It says this comment has failed to post to Tradier. Hold on.
Okay, we'll get it in there. And I put hub.tradier. I also put my email in there for everybody. And that is, there we go. We got hub.trader. Smart Options Trader is our YouTube. Check that out. Trading Hub is also YouTube. There's vol.land. Oh my God, we're getting all kinds of good things here. And send me an email, folks. So let me know what you're thinking. Today's episode was based on an email I got. We love talking about things that you want to hear about. So send us something and send me an email at lex@trader.com if you ever want to do a online private session on our platform or just talk about options. I do it all the time. Anything else from you, Jason?
No, I'll stand in for Mark and say happy trading.
Okay, happy trading. All right, everyone have a great rest of the week. Have a great weekend. We'll see you next Thursday on the Traders Workshop.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.